I don't know about you, but we're having a heck of a time. We're seeing cap rates go up. We're seeing sellers' expectations finally get adjusted. We're seeing massively up to 20% discounts on stuff that we saw just 3 or 4 months ago in the multifamily space. What are you guys seeing?
Yeah, so same with you, Ken. The capital market has really been constructed. And maybe what you don't see in Texas, what you see in Phoenix is because base price is high in Phoenix, relatively higher than Texas, a lot higher actually. And so, you kind of see not only the interest rate going up, but the amount of the lending available for a particular market may be restricted, which makes interest rate maybe even higher in that selected market. So we also invest in Texas, but not like you, we have only a few properties over there. We have found, San Antonio, for example, when we invest in that, the market isn't as restricted. But like Arizona, for the same lender, you kind of have fewer options, right? Because the lender would say, hey, we reach our cap at Phoenix, or, we didn't want to pull the trigger. There is opportunity. There's always the yin and yang to a question, right? So it also creates some opportunities for some bargain buying. We're maybe seeing a little bit of that in that market if the debt makes sense. If the debt is something, as you always talked about, Ken, is some sort of fixed element in there, then your kind of debt expenses is fixed. And for example, you can put it in a agency loan that has a step down that basically allow you to have lower prepayment penalty, or creating two layers of it. Both are fixed rate, one a little bit higher on the secondary loan, and the first loan is lower, to create that blended rate, but it's fixed. So these are maybe some ways to kind of find some great deals. And in order to find fixed rate deals, the property has to cash flow very well. So in order to do that, we're seeing maybe some more finished products that are being exchanged hand, because I'm in the multifamily value add space. We buy old properties. So in that area, in Phoenix, there's a lot of projects has already been turned. So buying these units and thinking about more of a yield play specifically, if the math kind of makes sense. So we certainly see a lot, like so much fewer projects that make sense that hit our table. And you have to kind of really dig a little bit deeper over there. So where the market's kind of going, and I do agree with you, I think there's probably maybe two more rise of interest that's coming up. And then we don't really know what happens after that. Stock market is showing some weaknesses over there, and crypto is certainly not sure if it's the bottom or not, because it's not moving down despite all the bad news over there. So all across the market, there is some issues that we do see investor also being more hesitant in investing as well. So overall, all of a sudden, just like the tides coming and go, the tides is kind of recessed right now, but people who has capital is making good deals. We are seeing some institutions are coming back to Phoenix, buying some projects, but at a much, much deeper discount. So we're kind of seeing that cycle compared to like a month ago, where, sellers' expectations still not adjusted. So there is more projects sitting on the market. Now we're start seeing some of the larger groups coming back and start acquiring again. So I think it's just a matter of evaluating your deal. Deals are sitting on market longer, and you don't have to have as much of a hard money down, earnest money. And you can negotiate. We negotiated a 10% discount with the projects that we're buying. And that's also a good time for some opportunities.
Yeah, there is. You're right. What the nice thing is that we're finally seeing sellers negotiate a little bit. One of the things that we're finding is that we're having a lot lower loan to value.
Yes.
So what that means to everyone listening is, there was a time where you could put maybe 30% down, maybe 35% down in that down payment, and the rest would be covered on some kind of debt or a loan. Maybe 65, 70, even at some of the higher times over 70 even. But now we're seeing in the 50s. So we're seeing 50% loan to value, which also means 50% equity. Are you seeing that too?
Yeah. So yes. So for the projects that we're buying, their cap rates are so expanded. Like I said, if they were a little bit better shape, their financial condition looks pretty good, we're still kind of be able to get 60-65% LTV. That's pretty high. Yes, on our traditional deals, when you run it up again, it would be like 50-55. And that's a great point that you mentioned, Ken. It's really about the cost of capital. So for folks who doesn't understand, like for syndication, we're pulling people's money together to buy an apartment. So the money is coming from our investor, and that is a cost of capital as well. So there's a certain rate, the rates that you're giving them as return is your cost of capital. And then there's your borrowing rates, right? So typically people give, I don't want to like throw people off on, so I need to use the word IRR, the return, basically average yearly return for all its intents purposes. Typically you see about, anywhere between 13 to 16%, depends on your investor database, what they expecting. But you're lending maybe at a lot lower cost, at the 6% or 5%, previously 3%, right? So that cost from 3% has raised up to 6%. That almost double your mortgages. And then that create a little bit of stress in cash flow management. But also on top of it, what Ken is talking about here is that you used to only need 20 or 30% down. And now you need a 50% down. That's 20% more than what you needed before, even double, right? Some people have 25% down. So your cost of capital just potentially doubled on you because you have all these investors, et cetera. So these are the reason why the deals don't make sense anymore. So the seller needs to take a discount in order for the number to continue work.
Yeah. So, right. The way I've explained it too is, let's say you're trying to find a $10 million loan from, or you're trying to buy a property for 10 million, let's say.
Yeah.
Well, and it's 50% loan to value. Well, if 50% was say at 6% as debt, and 50% was say at 8% for equity, your blended cost of capital would be 7.
Right.
So 50% at 6, 50% at 8. So the combination of that is 7. So that means that the deal for 100% of all the money is a 7% cost of capital. So you're always looking at the blended cost of capital between debt and equity. And what Elisa said was, as rates have gone up from say 3 to 6%, your debt costs have gone up. But at the same token, it's harder to raise money on the equity side. So a lot of people I've been seeing are raising their cost of equity, to try to raise more equity. So all that does is put more cost of capital on the entire project. And don't forget, the project pays everybody back. So it's the same project. So if you go like 1 year prior, it's the same project.
Right.
The only difference is your cost of capital has gone up both on the debt side and the equity side, right? Is that what we're talking about here?
Yeah, definitely. Yeah, definitely. Especially if you're taking out some floating debt last year, then you're kind of committed to that. And then, we do have a few projects in that bucket. These are the ones that you really need your incomes to like work it up to compensate for the cost of capital. And I think a lot of syndicator out there have used bridge loans in the last year or so. And then you could kind of get caught in the middle of all this. Yeah.
Yeah, I know. I did a video on that on Friday. It's doing very well on that exact issue. And it's funny, the comments on there, like there's some pretty testy ones, people, it's a sensitive subject. It's frustrating a little bit as a real estate investor. It's, we had a property, I think I shared with you, that we were an escrow on.
Yeah.
And the property was a nice value add. It was a property that needed a lot of work. It was really well located, and actually it was a bit of a pride of ownership, but the owner decided, to just keep it the way it was for a long period of time, but there's significant upside. Well, while we were in escrow, our debt costs went up because the Fed met and, we're raising their federal funds rate. And so our cash flow went from, 3 million to 2 million on that one asset. So, it was 3 million, which was about a 7% cash on cash. And then it went to 2 million. just because the debt went up. So it's the exact same property.
Right.
And I was like, man, like, and the seller asked, hey, would you consider, just make us another offer at a lower price? And I was like, we don't know where debt costs are going to go. And I'm afraid that if I do that and we close, or, and then I'm now stuck with something that potentially a floater that can go even higher.
Yeah.
And so we passed on the deal and just kind of waiting for these debt markets to flush out. What do you see? Do you see this? A lot of syndicators, I think, are kind of running blind to this issue. I mean, they're starting to see it, right? As the statements are rolling into their office,
right,
and some of this cash flow goes to negative. Where do you see all this playing out?
Yeah, so I think that's going to probably create, again, some buying opportunities. And I think, unfortunately, some folks going to lose some projects. If that's the case over here, I keep up myself at night, sometimes thinking about these. Now, what we have been doing is to try to mitigate a little bit. And thanks to you and the collectives, we kind of talked about this like beginning of last year. So the beginning of last year, we have put some rate caps on our rate caps is these insurance that you purchase to cap the rate. So your insurance will pay you back the delta. So we have put some 25 base point, which is 0.25%, the rate cap in the beginning of last year when it's really, really cheap to do so. And these are paying off really well now. And they're fantastic. But towards the end of the year, we don't cap it as much because the insurance has gone up. We run our numbers. It doesn't make a lot of sense. So these, we put a lot of reserves on them. I think reserves can help you. So for the syndicators out there, or people who is investing into syndication, you should ask your syndicator, how much reserve are you raising in addition to this to cushion this rising of interest if you're going to take a bridge loan? Now, we're going to see the bridge market, it's going to be really tough. And I think capital is really good at changing their course and pivot towards this. So we've already seen some capital, bridge lenders are pivoting towards pref equity, which is the secondary loan that you put on top of another loan. And then they restrict their policy to only lend on top of a fixed rate debt, like a Freddie or Fannie debt that is fixed rate. They will say, oh, I'm going to do the second piece on top, also fixed rate. So that blended rate could be an opportunity for people who are investing into these multifamily, because to your point earlier, the blended rate after fixed rate debt, because with Freddie and Fannie is still very low compared to other loans. And then the fixed cost on the top, you get the leverage debt, it's a little bit better leverage, combined rate maybe 65, 70% still, and then a combined rate of about 7, right? So that's a little bit better fixed rate at 7, but we've seen bridge loans are going 7, 7.5, 8. At that point, you're like, hey, look at some different creative financing. And I think for people who invest in these projects should, ask, what is your reserve? Do you have interest rate cap? And also, how are we mitigating this using fixed rate debt? Is there ways to kind of mitigating that? So for folks who are not looking at that, if you have very, very little reserve, then the investor may be expecting a cash call, which is, they will ask for more cash. But usually investors don't put in extra money if it's not doing well, unfortunately. So we may be seeing some project kind of falling out. So now what that is going to do to the industry is, I think it could creating a, SEC regulation, as investor becomes more disgruntled, et cetera. Some people is going to complain. This may creating a hurdle with security, because with SEC, because syndication is through security, it's the selling of security. And there may be SEC crackdowns coming down. So it may have an overall impact to our industry, not just to multifamily specifically.
Yeah, I agree with all of that. I think, and so for those of you who don't quite understand what Elisa said, there's what's called a capital stack, and every deal has a capital stack. So at the bottom of the capital stack is debt, let's say, or a loan or a mortgage, just like you have on a home. Then you have the equity, which could be whatever it is. And then you have other layers of capital. So it could be called preferred equity, could be called mezzanine, could be called hard money, or whatever it is. But you got to pay attention to the capital stack, because different capital has different requirements, different waterfalls, different, agreements around it. So as people start to try to get bailed out or bring in new money, sell off their GP interests, or maybe even bring in preferred LP interest, on the equity side, these all can change deals. They can change where the money flows. So it's important for you to understand now, like, I think Elisa said it perfectly. If the deal is undercapitalized, it doesn't have enough money, or they don't have rate caps, you need to be all over this. You need to find out what the plan is, what the reserves are, because it's the equivalent of somebody having equity in a house and not be able to pay it, right?
Right, exactly.
So it's the same, because a lot of these deals have equity.
Oh yeah, lots of equity over there, and which equity also gets impacted too, because people are taking discount on that. But the cash flow is at the end of the day kind of flows your business, like in any business, really. Multifamily is a business as well. Any investment, any business should be cash flow positive. And if you don't have cash flow, then you have to close your doors or being foreclosed.